Have you ever wondered how people make money by just watching numbers go up and down on a screen? Well, what if I told you that you could do it too, starting today? Do you think trading stocks is only for the big players on Wall Street? Think again. What if you could start trading today and join them even as a complete beginner? Common trading terminology, understanding basic terms. When we start trading stocks, it's like learning a new language. Two of the most important words in this language are long and short. These words tell us what traders think will happen to the prices of stocks, and they help traders make money whether those prices go up or down. First, let's talk about going long. When traders say they are long on a stock, they mean they have bought the stock because they believe its price is going to increase. For example, if you think a company like Apple is going to sell a lot of iPhones this year, you might decide to go long on Apple stock. You buy the stock at a lower price now, hoping to sell it at a higher price later. Just like when you're playing a video game, you're long on the idea you're going to win. On the other hand, going short is the opposite. When traders go short, they do something that might seem a bit strange at first. They sell stocks they don't actually own. They borrow the stock from someone else and sell it at the current price. They're betting that the price will fall, and if it does, they can buy the stock back later at a lower price, return the shares they borrowed, and keep the difference as profit. Imagine you borrowed a skateboard from a friend to sell for $50 because you think the price of skateboards is about to drop. Later, the price drops to $30 and you buy the same skateboard back to return to your friend. You just made $20 by betting the price would go down. That's what shorting a stock is like. Now let's make it even more fun with an analogy about bulls and bears. In the stock market, you often hear traders called bulls or bears. This might sound like a zoo, but it's actually about how they think the market will move. Bulls are traders who are optimistic and think the market will go up, just like a bull lifts its horns upward. So, if you hear someone is bullish, they're feeling good about the future and likely buying stocks. Bears, however, are the pessimists of the market. They expect prices to fall, just like a bear swipes down with its claws. A bearish trader is someone who is preparing for prices to go lower, often by shorting stocks. Understanding these terms, long, short, bull, and bear, gives you a basic grasp of trading strategies. It's like knowing whether to pass or shoot in basketball, depending on what the defense is doing. By using these strategies, traders try to make the best moves to score big in the market, whether they're playing offense, going long, or defense, going short. Remember, trading can be as fun as it is challenging, and knowing these terms is the first step to playing the game right. So, next time you hear someone talking about bulls and bears, you'll know they're not planning a trip to the woods. They're figuring out their next move in the stock market. The basics of trading. Introduction to the stock market. Welcome to the exciting world of the stock market. Let's break down what stocks are and how this big marketplace works. Imagine the stock market as a giant store, but instead of buying toys or clothes, people buy and sell pieces of companies. These pieces are called stocks. When you own a stock, you own a small part of that company. So, how does the stock market work? It's like an auction house where everyone is trying to buy and sell their stocks at the best possible price. The price of each stock goes up and down based on how many people want to buy it and how many people want to sell it. If lots of people want to buy a stock, the price goes up because it's in high demand. If lots of people want to sell a stock, the price goes down because there's too much supply. Now, how do people make money in the stock market? There are a couple of ways. The first way is pretty straightforward. Buy low and sell high. For example, if you buy a stock at $10 and later the price goes up to $15, you can sell it and make a profit of $5 per stock. This is what most people think of when they talk about making money with stocks. Another way to make money is through dividends. Some companies share their profits with their stockholders by paying them a little bit of money regularly, usually every 3 months. This payment is called a dividend. It's like getting a small reward for holding on to your stock. Remember, trading stocks can be fun and rewarding, but it's also risky. The prices can go up and down very quickly, so it's important to be careful and think about your decisions. That's why learning all about the stock market is a great first step. Key trading concepts. Learning about the spread. In trading, there are some very important terms you need to know: the bid price and the ask price. Let's make it simple. Imagine you want to sell your video game online. The highest price someone is willing to pay for your game is called the bid. Now, if you wanted to buy a game from someone else, the lowest price the seller is willing to accept is called the ask. So, when you're trading stocks, the bid is what buyers are ready to pay, and the ask is what sellers want to get. The difference between these two prices is what we call the spread. The spread is super important because it shows us how much we need to pay extra or how much we might lose when we buy or sell stocks. For example, if the bid price for a stock is $10 and the ask price is $11, the spread is $1. This means if you buy the stock at $11 and sell it immediately, you'd sell it at $10, losing $1. So, the smaller the spread, the better it is for traders like us because it means less money lost. Remember, understanding terms like the bid, ask, and spread, and using a good trading platform like Tasty Trade can really help you become a smarter and more successful trader. Happy trading, and don't forget to check out and make smart money. Types of trading orders. Different ways to buy and sell stocks. When you're trading stocks, you can choose different ways to buy and sell them. These different ways are called orders, and each type of order helps you trade in a different style. Let's dive into the main types you'll use. First, we have market orders. A market order is like saying, I want this stock right now no matter what it costs. When you place a market order, you're telling your broker to buy or sell a stock immediately at the best available current price. It's super quick and you almost always get your stock, but you might pay more or get less money than you expected because stock prices can change really fast. Next up are limit orders. Think of a limit order like setting a money-saving goal. You decide the price you want to pay for a stock or the price you want to sell it at, and then you wait. For example, if a stock is currently $50 but you think that's too much, you might set a limit order to buy it if it drops to $45. Your order will only go through if the stock reaches that price. It's a great way to control how much you pay, but there's a chance your order might not happen if the stock doesn't reach your set price. Then we have stop orders, which are a bit like setting an alarm. You use a stop order to buy or sell a stock when it reaches a certain price, called the stop price. For example, if you're watching a stock that's climbing and you think it will go even higher after it reaches $100, you could set a buy stop order at $100. Your order turns into a market order once it hits that price. This can help you buy into a stock that's on the way up or sell one that's dropping before it goes too low. Lastly, there's something really important called a stop loss order. This is used to prevent big losses. Let's say you own a stock that's worth $100, but you're worried it might drop. You can set a stop loss order at $90. If the stock price drops to $90, your stop loss order becomes a market order, and your stock is sold at the next available price, helping you avoid further loss if the price keeps falling. All these orders, market, limit, stop, and stop loss, are tools in your trading toolkit. They help you manage your trades, whether you want to buy quickly, wait for a good price, catch a rising stock, or cut your losses. Each one has its pros and cons, but by using them wisely, you can make smarter, more effective trading decisions. Remember, trading is not just about making money fast. It's about making smart choices to help grow your money safely over time. So, take your time to understand these orders and use them to your advantage. Thanks for tuning in. Don't forget to hit that subscribe button from Make Smart Money to join our community and never miss out on our trading tips and tricks.